Hello, everyone. Welcome back to another Lunch and Learn webinar series. And I'm your host here, Mayur Thaker. I am an analyst and co-portfolio manager of the Zacks Earnings Certain family of portfolios here for Zacks Professional Services. And today we're going to do take a look at 3M. 3M is one of the holdings of the Zacks Earnings Certain proxy. It's been a long-time member of that portfolio, and it's been in the headlines and in the news recently over the past several months for a couple of, several negative, items. So we're going to take a look at 3M and, specifically why I believe 3M is now a deep value opportunity, in terms of their shares. So let's take a look at what 3M is, who they are, what they do, how they make money, and what has been affecting their stock price and what the future might look like. So let's get started with that. So 3M, just as a brief introduction, 3M, everyone, most likely knows what they do, but just in case you didn't, 3M is one of the world's largest industrial conglomerates. They operate across four key segments: consumer, healthcare, safety and industrial, and transportation. We'll take a look at some of these here. What you might know 3M for specifically is their consumer line of products, but what people don't really know about as much are the other three. So we'll take a look at what each one really does. So here I just have a couple of screenshots of their key products in each segment. The consumer, again, everyone here probably recognizes these brands. They are Post-it branded stickers. They are Scotch-Brite. Every time we wash dishes, we're most likely using Scotch-Brite cleaners. Command tapes for hanging picture frames. Scotch tape. Again, that's almost become a verb. All tape is usually called Scotch tape. Even though Scotch is a brand. But yeah, these are all brands owned by 3M. But what people don't know about as much are what they do for these other industries. So they actually make a vast number of adhesive sealants. They make electrical tapes. They make all kinds of laminates. These are items that are used in transportation, specifically for railways and airlines. During the construction of airplanes, Boeing and Airbus are, big customers of 3M because of all these small parts that go into the construction of airlines as well as for railway cars. They make all sorts of, laminates and, materials that are used in the construction of trains. They also have a fairly large healthcare segment. Healthcare is roughly 1/3 of their revenue. And here they make things like, these, bandages, gauze, tapes. This is, very much, they also have a product for they have dental products as well. If you've gotten any dental fillings, they make, the material that goes into, dental filings, the fillings inside of your teeth in case you have a cavity. That's what they make there. And they have, these are just a sample of products, but there's literally hundreds of items total, in terms of the number of SKUs that they have. And then on the safety and industrial side, this we became very familiar with during the pandemic. They make N95 masks. They make protective eyewear. They make PP&E. So their products were very heavily relied upon during the pandemic, especially for healthcare workers. So these products are embedded throughout industry. They have decades and decades of network effects and relationships at hospitals, at labs, at industrial companies as well as transportation companies. And then ultimately they have, a very, very strong relationship with consumers. As you can see there, these brands are, prevalent and ubiquitous at every major retailer throughout the United States and Canada, as well as throughout Europe and other countries as well. So 3M is deeply, deeply embedded across industry. It's almost a cross section of the American economy because their products are used all throughout industry. Here's a quick look at what's actually been happening. So this is a chart from our ZRS product. That is our Zacks research system. That is our software, platform for doing equity analysis. And here is a chart that overlays the stock price with their earnings, growth over time. And you can see here that currently the stock trades at the lowest, multiple, to earnings in decades. Really, the lowest point it got was during the Great Financial Crisis, where it traded roughly at a PE of 10. That's roughly what's happening right now, is that it's being priced at roughly a PE of 10. In fact, if you look at next year's earnings, it's trading at exactly a 10.6 PE as of today. So it's gone through significant multiple contraction here for a number of reasons. The growth of the business has slowed a little bit, ever since the pandemic. We got a big lift, but then since the pandemic eased and since we reopened the economy, that huge bump that we saw in safety equipment gear kind of reversed itself out. So we're kind of back to where we were just before the pandemic started in terms of earnings. And so the stock has responded to that. But there's also something else that's been going on with 3M, which is very important to look at as well. But here I just have a chart of the earnings growth over time. And over the long run, they have compounded earnings at a roughly 7.4%. Now, it's been below trend for the last several years, and we're going to take a look at exactly what's been going on with that. Here is a chart of something that I make sure I look at, for any company that I evaluate, which is what is the track record of capital allocation of the company. So on the left-hand side, we see the return on invested capital. This tells you the result of management and the strength of the business. The higher the ROIC, and the higher the ROIC for a longer period of time, the bigger the evidence of a durable moat that they have. And here you can see that ROIC for years came in roughly at 18% on average. It has come down quite a bit since then, and that's one of the reasons why the stock is down so much. And we're going to take a look at a couple of the reasons why that's been happening. At the same time, you can see that the company has been allocating, back into the business at a very steady pace. You can see the invested capital, which is the denominator of this ratio, has been increasing, which means that the company is retaining some of its cash flow to reinvest back into the business for growth. And that's exactly what you want to see in order to achieve compound growth over time. You want high ROIC, and with ample opportunities to reinvest cash flows back into the business. That's what allows the compounding effect. And that's exactly why earnings have compounded, as you can see here, over time. It's fallen into a little bit of a trouble in recent years, but you can see that the long-term trajectory has been up at a rate of 7.4% per annum. And that's really the reason, and you can kind of break that down into these two subcomponents of earnings growth. Capital reinvestment times the return on invested capital, as you can see there. And even now, the company still delivers, quite, robust ROIC in the 14% range, which is still very good. So now let's take a look at some of these recent events that have been, really, clouding the stock. So 3M has been embattled in a lawsuit. Basically, a long story short, remember, they make all sorts of product, going back to their product lineup within the safety and industrial side. They make, not just PP&E for healthcare workers, but they also make water filtration systems. And here is an example of that, an image right there of that. And what had happened is that, it turned out that one of their water filtration systems ended up being faulty, and they found harmful levels of PFAS is what they call it. And that is a, toxic substance that, is dangerous. at certain levels, and they found those PFAS at higher than allowable levels in drinking water. And that's been a major source of pain for the company, because this has now led to lawsuits coming in from over 20 U.S. states. And so now that they've been working through that for over a year now, they have finally come to an agreement to pay, $10.3 billion, to settle these claims. The total amount of payment will be roughly $12.5 billion. The net present value of that is about $10.3 billion. So that's the total cost that 3M is going to have to pay to be able to make these allegations go away. And so that's definitely going to weigh on the liquidity position of the company. However, I make the case here, and we're going to take a look at some of the numbers, that they're going to be able to work through this and be able to fund these claims without taking too much of a hit to the business itself. And at the same time, you can see that the company continues to reinvest back into itself. Remember, as we saw in the capital allocation chart, the company has a pretty strong track record of very steadily reinvesting back into themselves to grow again. And that's, critical to achieve compound growth. And, just in May of this year, they announced that they're set to invest another $146 million to expand its capabilities in biotech manufacturing. So they reiterated that commitment there, despite the fact that they have these issues ongoing on the litigation side. They also have a partnership with Svante. This is a company based in Canada, British Columbia. And they are working on a solution to trap, carbon dioxide in the air and remove it permanently. So this is a carbon capture technology. This plays very well into the ESG sort of realm, and it's expected to have almost an immediate impact on revenue and profitability as well. And so this partnership is going to be another sort of way to make the company even more, robust in terms of product lineup. And it's also something pretty new, because remember, 3M is using its core competency in filtration, right? Remember, it has a number of, advantages and long-time R&D expertise in air filtration technologies, both for masks, for water filtration, although that hasn't had a good look recently. But over time, they've had a tremendous amount of R&D capability in making these types of filtration systems. And so they're applying that core technology now to carbon capture, which is very, very exciting, and a new source of revenue to leverage existing technology. So this is what we love to see. This is an existing platform that they have, and they have now figured out a new source of revenue to monetize an existing platform. So there won't be much incremental R&D associated with that, because they already have core patents and core technologies already developed. And now it's just going to be incremental revenue on existing patents and existing technologies that they own. So this is, again, very, very good overall to make sure that the company can continue to reinvest in itself and to continue to innovate to grow over time. So what they also have done is they plan to spin off their healthcare segment. Remember, this is a pretty big deal, because remember, healthcare is 30% of their total revenue. But what they've found is that, and this is actually bullish, even though initially it seems a little bit bearish, because they'll be giving away a very, very stable part of their business, which is healthcare. Remember, healthcare doesn't have as much volatility as transportation does, for example, in terms of its revenue intake. Because remember, demand for medical applications is very steady state. It doesn't get affected by recessions as much. So that's a very strong asset for them. However, the good news is that they will still retain 20% ownership, but the spinoff is expected to unlock value. And by that, we mean that the total dollar amount raised from the spinoff exceeds what the implied market value of that segment is if it's a part of 3M today. So independent M&A analysts have kind of determined that currently their healthcare segment implied in today's market cap is less than the amount that they would generate if they spun it off, which means that if they spin it off, that would unlock value for shareholders. And this is coming at quite an important time because of this huge settlement agreement that they've reached. They're going to need new sources of liquidity, and the spinoff, is coming exactly at the right time, which will help them offset, that huge expense. Because remember, one big fear is that the company is going to have to take on an uncomfortable amount of leverage to be able to pay off this huge price tag of $10.3 billion to settle these lawsuits. But the spinoff is expected to have to lift a huge part of that burden. And again, we'll still continue to retain 20% ownership of that new entity. So 3M will still have some of those benefits and yet still get to unlock value because the proceeds will exceed the implied value of the entity that's held captive within the company. Also, they just reported earnings this just 2 days ago, and they actually raised their guidance. They raised it to $8.60 to $9.10 adjusted earnings per share. That's up from a prior $8.50 to $9 per share. And they're also guiding for 90 to 100% free cash flow conversion. Remember, this is very important because as equity analysts, we love to make sure that earnings are being confirmed by free cash flow. And remember, the highest quality companies out there can convert 80%, roughly 80 to 90% of their earnings into free cash flow. 3M is guiding for 90 to 100% free cash flow conversion. So again, this is a very, very strong core business. Apart from the fact that they have this very nasty lawsuit, the core business remains extremely strong. And at the same time, they're working on an initiative to streamline operations. So they are laying off 6,000 employees worldwide. They're working on a program to simplify their supply chain. They're prioritizing high growth markets and cutting low growth markets, low profitability markets. This is expected to improve annual operating income by 700 to 900 million. So that's an additional benefit that is expected to be realized that will help them, deal with this lawsuit. Also, keep in mind, this $10.3 billion, I didn't mention this earlier, but this is not a all-in-one sort of payment. This would be paid over a period of 13 years. So you can see that listed right here. As a part of the settlement, 3M will provide funding of up to $12.5 billion to PWS, that's Public Water Systems, over a period of 13 years. Okay, so this is not all at once. That was one of the fears that the market had, that investors had, is that it's going to create a massive liquidity drain up front, which will require them to lever up the balance sheet to uncomfortable levels. It's looking like that may not actually have to happen, because if they can break up these payments over 13 years, then that becomes a very manageable payment to deal with. And their newly announced cost-cutting measures should be able to provide an 80%, that's my estimation here, 80% offset to their annual contribution requirements into that fund to fund this, to pay those funds, to deal with this lawsuit here. So this cost-cutting measure alone is expected to be able to cover most of the liquidity needs of this lawsuit settlement. In addition to that, again, raising their 2023 guidance, that helps even further be able to offset this liquidity drain. So here are my sort of primary conclusions. The 3M's core business remains very robust. Here you can see a chart of their free cash flow per share over time. This is, compounded very steadily. You can see it does have a little bit of seasonality here. This is a quarterly free cash flow, chart here. So it's not, smoothed for seasonality. But you can see that over time, the company has had a track record of compounding growth over time. And here you can see the latest figure that was reported just 2 days ago. That's the Q2 free cash flow. It came in at over $2 per share. That's quite a nice rebound from Q1's low point and, well off the lows of Q2 of last year. So I believe that the core business is on a fundamentally upward trajectory. Although this number will probably drop as soon as it will drop as soon as they spin off the healthcare segment. That's okay because they're getting that upfront payment, which exceeds which is estimated to exceed the implied market value of the healthcare unit, held captive within the company. So, again, healthcare spinoff expected to unlock value, which means that the cash raised from the spinoff exceeds the implied value in 3M's current market cap. Again, that should be very helpful in partially financing the PFAS settlement, in addition to the cost-cutting, streamlining measures that they already started, which should provide benefits in the range of $700 to $900 million per year. Here's another, key question that, that investors have, right? A major reason to own 3M is its consistent dividend growth for 30 years. Right, 3M is a dividend aristocrat. It's in every dividend aristocrat index and ETF. It has paid and raised dividends for a very, very long time, as long as anyone can remember. And right now, because of the bear market in the shares, the dividend yield has now reached 5.5%. That is very, very attractive. It's the highest yield in basically 3M's history. However, because of this lawsuit, the questions are arising about the sustainability of its dividend. Are they going to have to cut it? Or can they sustain it? That's one of the reasons why, stocks yield very high yields, or it reaches high yields, is because investors doubt whether that dividend can actually be paid, right? My contention is that they will be able to pay it. And here's why. So here's a chart of their dividend per share. You can see very, very, very consistent ladder growth over time. You can see that they've actually paused the growth in the dividend ever since they've had these issues, core issues, and free cash flow has kind of taken a breather here. But you can see that the current dividend is roughly $6 per share, and the free cash flow per share is $7.60 per share. And keep in mind, this number is as of Q1. My chart here is not yet updated for Q2. But as we saw, the Q2 number improved sequentially. So this spread has, only grown over, as of Q2. So this means that the dividend is very comfortably covered by the company's internally generated free cash flow. So I believe that this dividend will continue to get paid. Why? Here's some quick balance sheet math. So the biggest question is whether 3M's $10.8 billion settlement will be accepted by plaintiffs. That's the biggest question right now. Because there is a chance that states reject it, and the judge that's overseeing the case, rejects 3M's settlement offer. So there is a chance that could happen. I don't think that will happen. Many analysts that cover 3M don't believe that's going to happen. But it is possible that could happen. But here's some very quick balance sheet math. So as of Q2, which, as I said, they just reported on Wednesday this week, I believe it was on Wednesday. They have cash and equivalents of $4.3 billion. They have free cash flow of $4.8 billion as per guidance. That was some implied math based on their earnings guidance and assuming 100% free cash flow conversion, which is what they guided for. And then if you were to deduct their cash dividends of $3.3 billion, that's their trailing 12-month figure. so assuming that they don't grow the dividend much anymore, which is probably a good assumption, that gets you to net cash at the end of the year of 5.7 billion, 77 billion. And then they have about 3 billion in short-term debt coming due, right? So let's say they pay that off instead of refinancing. They could always refinance it, but let's say they pay it off just to be conservative. That brings them down to 2.77 billion in cash and cash equivalents. This is the amount remaining to pay off the first of many settlement payments. So this to me is actually a very, very positive development, because this still tells us that even if they continue to pay the dividend, and even if they pay off all 3 billion of short-term debt coming due over the next 12 months, they're still going to end with 2.77 billion in cash. That's the amount of cash that they have left over to start the first of many payments into the PFAS settlement fund. And if you can assume that, the first payment will be roughly $1 billion, we don't yet have the details of that. But even if it's a $1 billion payment, that brings them down to a $1.77 billion cash position. That's still a pretty comfortable position. And keep in mind, this is not a cash burning company. At its core, the company generates cash at a pretty decent clip. So the core business, again, remains strong, as you can see here. This is a chart that looks to me like it's very healthy, and that the core business is, in fact, turning around here. And so if this continues to happen, which I believe it will, this is a company that will continuously increase its cash position, despite the fact that they have this huge settlement to fund. So here's my conclusion, is that the combination of a world-class consumer brand, remember, these are brands that have withstood the test of time. Brands are, a number of research studies show that strong consumer brands are capable of generating high and above average returns on invested capital, which is why 3M has proven that in our capital allocation chart, as you can see here. This has, withstood the test of time. Even though it's come down in recent years, I believe that this number is going to stabilize in the 14% range, which is still a very high number. And I believe it'll then improve back to 16% roughly over the next 2 to 3 years. But again, even if it stays, in this 12 to 14% range, that's still a very healthy number. And remember, given the fact that the stock now trades at a PE of 10, tells you that, we have the combination of a world-class consumer brand, a recession-resilient business, a very strong core business that generates positive and growing free cash flow, and at the same time, the deep value multiple that it has right now. This is setting up for a tremendous opportunity to achieve outsized returns over the next 3 to 5 years, if the company can move past these two controversies. So again, if you look at the Shiller PE ratio, I love to look at this because this tells you the multiple that the stock trades relative to normalized earnings per share. So this looks past short-term difficulties that companies have and assumes that the company can get back to normalized earnings, which means an average earnings over the past 10 years. If it can simply get back to average earnings for the past 10 years, it doesn't even have to grow much, but it just has to get back to trend. If it can just get back to trend and achieve a average PE multiple because of that, then there's tremendous upside. And you can see here that 3M is now priced at a multiple even cheaper than the lows of the great financial crisis. So this to me is an opportunity to buy one of the strongest brands in the world, an iconic business, a Dow component, for pretty much the lowest multiple that it's ever traded at in decades. And so my price target is $200 per share by the end of 2026. That's a 22% CAGR from today's price. And again, this is based on very modest assumptions. Number one, that the plaintiffs and the judge really agrees with 3M's proposal to pay over $10 billion in a settlement. and that the core business returns to long-term 4 to 5% trend earnings growth, which the company is pretty much already guiding for right now. And the PE multiple returns to 15 times, which is very reasonable for a long time, consumer business that is deeply embedded throughout industry and produces 14 to 15% returns on invested capital. I think that's a very, very reasonable PE to expect, and it's at a pretty big discount to the market. The market's at a 20 PE right now. I'm expecting a 15 PE for 3M for a high quality business, a very, very strong consumer brand, and a business that has pretty strong recession resistance, even despite the fact that they're spinning off their healthcare segment. So for me, for a business like 3M, I believe number 2 and number 3 are likely. The biggest question now remains number 1. But here's the thing, is that I believe that because of the valuation today, the market's already pricing in a very negative outcome from number 1. And it's discounting numbers 2 and 3. So given today's implied expectations, I believe that, the company is striking out on all 3. So if any of these, ends up coming to be true, either the PE multiple returns to a 15, or the core business returns to long-term trend growth, or the company can finally move past this dark chapter in their history. If any one of these ends up happening, I believe that the upside is tremendous. And if they can get through all 3 of these, which I believe is a very strong possibility of happening, then I believe that despite the fact that this is a very boring, a very slow growth business, you could achieve a significant return on your investment from today's prices. And the stock is up quite significantly ever since they reported, Q2. I think the market is starting to sniff out a turn in the core business here, as you can see from their free cash flow, recovery. It does look like this trend has continued and it has resumed its uptrend. Again, if it gets back to just long-term trend growth at roughly $2.50 per share on a quarterly free cash flow basis, I believe that the stock can finally get past this really, really dark chapter in its history, and really get back to the multiple that it normally trades at, which is roughly 14 to 16 times. As you can see, it traded throughout most of its history. You can see that there's a very comfortable spread between the stock price and its earnings stream. But you can see that only twice in this entire history has that spread basically vanished, during the great financial crisis and now. So again, if you believe that 3M can navigate through this successfully, then this is a significant, almost generational opportunity to buy shares in a generational brand. So I hope you guys found this helpful. If you have any questions, I'd love to hear from you, any feedback, or if I missed anything, I'd love to hear from you guys. If you are a ZRS client, please do send us an email at zrs@zacks.com. And if you're an Advisor Tools client, please send us an email at zat@zacks.com. All right, thanks everyone. Talk to you soon, and see you in the next one. Take care. Bye-bye.